Right, hello everyone. Thanks again for attending. It's Jasper Lawley here, representing London Capital Group, and we are today covering a webinar topic which is trading major market events. This is particularly something that's of interest to people who are new to the markets, because it's a little bit hard to kind of really gather what on earth is actually moving market prices, and you can quickly realize that actually some of the biggest price moves happen around certain events, some of which are scheduled, some of which are not predictable, but there are some ways you can react. So that's the general idea of what we're going to cover here. Obviously this is there are people that make a very nice living off this exact trading news type strategy, and preparing for these events. So I can't cover it all in half an hour, but certainly hoping to cover most of the bases. So these are the topics as we're going through it today. Trading major market events. What are the big events that move markets? Why consider them? Well, I've already slightly covered that, but we'll talk about it a bit more. Talk about some of the pros and cons of trading these events. Something called the market impact factor. I've definitely heard that somewhere. I'm pretty sure I didn't make it up. But basically the idea is how much of an impact on the price are these events going to have? So 3 questions you can ask there is how important is the event? What are the expectations for it, and how has the market moved beforehand? And then we'll just cover 4 simple strategies of ways to trade the event. Now I want to just emphasize that yes, these are some ways to enter the market, but don't discount these first 3 points, because you really need to get a kind of setup for where we are in the market before you decide which one of these strategies to go for. So you don't just employ these strategies at random. The success that can be had from them really kind of depends on the kind of pre-game analysis, if you like. So just covering some examples here. So as I mentioned, some of the events are unpredictable. So at the bottom I put obviously war, the sudden outbreak of war, natural disaster, something like 9/11 happening or something. You saw the price of gold skyrocket, airline shares crash. That was, people didn't know that beforehand. Well, some conspiracy theorists think they did, but theoretically they didn't know beforehand. So really that's purely reactionary. But if you obviously following a market closely, you see the news break. If there's enough momentum in the market, then you can still jump in, and as more people jump in after you, the price will be carried in, hopefully in your direction. But some of the events are scheduled, and I guess that's probably, I've put an extra R in there for some reason, but some of these events are scheduled, which allows planning in advance. So that does open up a few more options when you know this event is coming. So the obvious ones day to day, week to week, are the economic data. So in order of importance, I would say we've got NFP, which of course we do a live webinar for, and you also got unemployment data from other parts of the world as well. Interest rate decisions, central bank comments, CPI, which is inflation, GDP, which is basically economic growth, and more if you're trading the commodity markets, those top 5 are a little bit more orientated towards if you're trading forex or fixed income. But yeah, if you're trading commodities, the inventory reports, so the crop reports, what the crop yields are. Obviously every week we have oil inventories data from the US, and so that gives you a little bit of a feeling as to what the supply of that commodity currently is, and you can obviously make some gauge of how that stacks up against demand and make some call on the price. Obviously if you're trading shares, corporate earnings are going to be pretty much top of the list in terms of events that you know are happening and can cause some pretty sizable price moves, especially of late, because particularly in shares that are popular with traders at LCG are the big US tech stocks, and a lot of these shares are really priced to perfection is one word for it. So their valuations are very high, so the share price factors in massive growth in the future. And so when something's priced to perfection, obviously even if you slightly disappoint, it can cause a quick unwind of those lofty expectations and cause some pretty sizable price moves. So if you're positioned for that, you know, you can catch 20-30% moves in a stock price in a day, which is obviously pretty nice if you can do it. Political elections and events, obviously that's been a big theme for the last couple of years. So generally they are scheduled. There will be sort of sudden unexpected announcements or comments from politicians and people related to the issue that can cause unexpected market reactions. But if you're waiting for an actual election result, obviously, or maybe a certain poll result or, you know, referendum result, then it's some you know, within a kind of zone of price, if you like, you're going to see some kind of market reaction. And then as I mentioned, there are just some unpredictable things. I mentioned the natural disasters and things, but obviously corporate scandals as well. Data leaks are something that happen quite a lot these days. You know, if you hear about a data leak happening with a company and the market's open, certainly worth jumping into the trading platform and seeing how much the market's moved by the time you heard about it. Because if you are one of the first to hear about it, you manage to catch it as it crosses the wires, this can cause some big price moves, and it doesn't necessarily have to end in one day, particularly when the company's slow to react. Not so long ago we had the Cambridge Analytica scandal with Facebook. There's a really negative reaction on the day of when it really kind of started to kick off, but the share price dropped definitely plus 10%. I think it was in the regions of maybe 17% over the course of a couple of weeks. So, you know, it's this idea of momentum and trends in the market. You know, if you're aware of what's driving the price, you know, you can make a judgment as to how far it can go. Anyway, enough of all that. Why even look at all this in the first place? Well, the main attraction is a quick buck. So you'll notice that, you know, I've put the pros and the cons are somewhat similar here. So volatility, you know, some people think it's a bad thing. It's not. It's a good thing for trading, because you know, you need the price to move, and that's what volatility represents. But obviously, the price can move in a speedy fashion to these market events. So if you're if you're positioned correctly, brilliant. You know, if you're positioned to the wrong way, you know, you can suddenly find yourself with, as I mentioned here, some fast losses as opposed to fast profits. So all well and good in your general trading, saying, well, cut the losses short, let the profits run. Yes, you can still do that when trading market events, but when the market's moving very quickly, it does limit your capacity for cutting your losses. So that's just something to be absolutely aware of, that actually generally trading these big events is probably a riskier proposition than your average trading strategy. One thing I would say that is good about it is that oftentimes it's difficult, even if you have a feeling as to where the market's going, to actually know when to enter it and start taking advantage. You know, these events, if they do have a fixed time when they are occurring, you pretty much know you want to trade right before or right after that particular time. So it helps with the timing of the entries. Downside is that because the market is moving so fast, back to this idea of the volatility, can cause some emotional trading. Suddenly, maybe you have a plan going into it, but the market starts moving all around the place. Suddenly you're in a massive profit. Suddenly the profit's cut in half. Suddenly you're in a massive loss. The loss reverses. It can cause the need for some very quick decisions, and sometimes those decisions can get a bit emotional based on the amount of money that's going in or out of your account. So if you are going to do this, be prepared. for that kind of emotional whipsaw. And the downside, I suppose, with using your demo account is that you can't really properly sense that unless it's your hard-earned money. So over to this idea of the market impact factor. Basically what we want to decide is this event worth trading, is the first question, right? So I've used the example here of non-farm payrolls. You can see, I don't know, I've got the, what's going on? Okay, so sorry, apologies for that. I've got the slide the wrong way around. How important is the event? So here you can see this is our economic calendar right here. And what's useful in terms of economic events is that right here you can see that there are little exclamation marks telling you the importance. So obviously the Reserve Bank of Australia, they've made a decision on whether or not to raise interest rates, and then they have some minutes on that meeting. That's of high importance. Something like a Polish industrial output for May, less importance for the overall market, right? So you've got a kind of just a smaller exclamation mark there. So when it comes to economic data, that's quite easy to judge. You know, after a while you get familiar with the big events anyway, but there's the market calendar to help you. Otherwise, it's more just being kind of track, you know, just being in the flow with the market and understanding what is driving things. So, you know, if Italian bond yields are jumping up and the FTSE MIB index is dropping ahead of the Italian election or some big decision from the Italian president, then you obviously know that that decision's important, right? Because you're following it anyway. So that, again, is as long as you're following along with the market, you should kind of be able to judge the importance of the event. Again, if it's, you know, maybe, you know, it's an unrelated country, there's some, you know, election taking place in Argentina, but, you know, you're not doing anything with the Argentine peso, you know, okay, it's not important for you in terms of your particular trading, probably. So then back to this idea of what are the expectations. Again, this in terms of economic data is very easy to find on the LCG economic calendar, which you can find on this link here. So this is important in relation to the next point, which is, so, and then I'll elaborate a bit more when it comes to the actual trading strategies. So what are the expectations? Obviously, you need basically the whole upshot of why the market moves after these events is that the market has a certain thought about what's going to happen, a collective idea and what's going to happen. Obviously, there are some people who believe the absolute opposite, but, you know, there's a sort of average opinion, if you like, in the market about what a certain event will do to the price. So generally, the reaction in the market after the event is a function of how much the actual event differed from what was expected. So generally, the biggest market moves when you're trading these big market events is when something unexpected happened. You only have to look at a chart for the British pound to see that Brexit was not expected, and it caused an absolute nosedive in the currency. So that's obviously a pretty obvious example right there of the actual result causing a different result to expectations. But the same thing happens in economic data. Now there's some nuances to this which I'll cover in a little bit. So obviously you need to judge firstly what are the expectations, but then in comparison to that, how has the market been moving up until the event? So one thing like this is just a slide I took from when we were looking at the last UK general election, which again was another good example of something unexpected happening to some extent. The Conservatives still won, but they actually got a lower majority in Parliament. Everyone was expecting them to expand their majority in the Parliament. You know, generally Conservatives considered more market-friendly than the Labour Party here in the UK, so that was a negative event for the pound. Even though the Conservatives got in, which is, you know, in theory a good thing, you know, if you go by history and what these parties mean for the market, the expectation was that they would raise the majority, so they missed that expectation. Obviously, they got a lower majority of MPs in Parliament, and so the market reacted to that miss of expectations. And you'll see here that actually volatility was relatively low. So volatility is, you don't have to look at volatility in terms of an actual price representing the volatility itself. You can use things like Bollinger Bands on your day-to-day price chart and make a judgment as to, is the market moving directionally, and is there a big trend going on leading into this market, because the market really has a strong belief that something good or bad is going to happen, and it's already kind of starting to price it in. Is it a large trading range? Is it a very small trading range? You can get a feeling as to how volatile the market is, and then I'll elaborate on why that can be important for the strategies that we're about to cover. So strategies to trade the event. First one I want to cover is probably the most straightforward, and the way I think this is probably an area that newbies will initially start with, and many people who don't really explore the idea of trading these big economics events probably don't move anything beyond momentum. But there is some logic to it, and I'll explain that here. So you can see on this chart, firstly on the right, got E1 representing your entry into the market. So the idea being that the market's kind of been consolidating roughly before this market event, and then the news comes out and the market tanks. I think this is a dollar-yen chart, so obviously it's been presumably some negative back in November, but presumably it was some negative data, negative jobs data for the US, and the dollar tanked. So logic being that so obviously you could do this for any data release, but I would suggest that actually probably over time what's going to happen to you more often than not is you end up with an entry down here at E1 where the market's kind of constantly gapped quickly and then just reverses back on you. So you want to avoid this initial gap, but even if you can't avoid that, what you want to try and position yourself for is a market that continues dropping down even if you get the lower entry, because of the speed of the decline. Your entry's lower, but the market keeps dropping. So either way, you're in money. It's just a matter of how much. And I think probably the way to distinguish when to use this strategy is, if you've not read it already on the left here, if there's a narrow consensus about what will happen, then the market will try to discount that risk and will be positioned for the consensus already. So you can argue perhaps in this case that there had been a bit of a general drift higher in the market, not obviously so, but perhaps the market was positioning for some stronger US data, and then you see the size of this reaction afterwards suggests that actually the data missed the expectations and had to unwind all of this built-up expectation and more so. So basically the opportunity there, as we sort of talked about before, is if the data misses these narrow expectations, everyone is basically, if you're expecting the data to be really good, right, everyone should be buying the dollar in terms of US economic data ahead of what's expected to be good data. And everyone thinks the consensus is for 250,000 jobs, say. If it suddenly turns out to be 350,000 jobs and everyone thought it was 250,000, that's obviously exceeded expectations. So the market would fly higher in the same direction. If it ends up being 150,000 and misses that 250,000, goes the other way, then obviously you get that drop, similar to here. And that's the opportunity that you can only know this. So just reiterating again what I'm saying here is that everyone's scrambling to reverse or double up on the trades, but you can only know after the data's released. So it requires that jumping in with a market order once you see the market move or you see the data and you go with it. So the other one is the fade, or just fading the initial move. So that same market event we were talking about, oftentimes why you get that initial move, but then the rebound straight back again, is that the result is not that black and white. It's not clear. It's uncertain or mixed. You know, the good example with NFP is you often, especially these days, there's a lot of focus on average earnings as well as the headline number of jobs created. So if you get weak earnings growth but good jobs growth, then it's a mixed result, and the market's not really certain about which way to move. So there will be some sort of move normally, but the uncertainty means traders have less conviction about the initial price move, and so the opportunity exists to trade the market back towards where it started. So if it reverses that initial knee-jerk reaction, traders can fade the market by trading against the initial move and target the price before the event. So normally this would mostly be done using market orders. You make a judgment about the initial price move, you make a judgment about the mixed nature, the uncertain nature of the event, and then you wait for a sufficient drop in this case, or maybe a sufficient rally, and either sell the rally or buy the drop. This has the advantage of not having that kind of slippage factor, which trading with momentum tends to have. But obviously, yeah, you risk getting the idea wrong. Actually, maybe the market's a bit more certain about the result than you think, and the market continues in the same direction, in which case you'd probably be stopped. But you have a bit more control, perhaps, over limiting your losses than that pure momentum strategy. But it's surprising how often the market will just reverse back these price moves. So another option here is a straddle. And again, it's in theory something you can just do with every major market event that's happening. But when I think it works best is when there's a wide consensus about what can happen. So opposite to that first idea, when we were using momentum, if there's a lot of uncertainty, then the market really can move in either direction because it didn't know which way it was going to go. So if it's a big event in one direction or it's a big event in the other direction, theoretically either one can cause either a large price move or no minimal price move. It's going to be one of those two, obviously, but either result can cause that. So the risk to this strategy is that you jump long or short either side of the previous range. So you can see I've kind of drawn a box around the previous price range here. The risk is that it just kind of does a sort of fade type scenario where it flies one way and then it's not that certain, and then it heads back again, maybe even hits your long as well. So it can get messy. There are risks, but the idea is that you're going to capture that sharp move in either direction because it could go either way. So the straddle is a market neutral strategy where you don't really want to go long or short. You're just waiting to see which way the market goes, and you have orders in place to take advantage. And just to conclude, the idea is to set up for a possible profit when the market moves either up or down. And then the last one, which isn't always discussed, but I would actually say it's probably my favorite way of using the news, which is, and I've shown you this, if you've watched some of my other webinars, you will recognize this particular chart that I've used here to basically kind of describe the way news interacts with the market in different environments. So what I'm trying to demonstrate here is that if it's a bear market, if we're talking kind of longer term trends or, just a downtrend in the short term, if some good news comes out, that can actually be a perfect opportunity for you to sell at higher prices within a downtrend. So while that news is good, for example, again, non-farm payrolls, say this is a dollar-yen chart again, some good US data comes out, pushes the dollar higher, but the overall trend of the market is down. So actually what this what this event has done is just provided you with a perfect opportunity to trade the pullback. Equally, say the market is in this kind of downtrending period, and you're trading the dollar, and the news that comes out is very weak. It's some bad news. Well, you can see that during the downtrending environment, bad news has a bigger effect on the market than good news. And eventually, good news starts to have a bigger effect. Bad news starts to have a lesser effect, and eventually, it's actually the good news that the market starts reacting to in the uptrend. So, going back to this downtrending example, the bad news comes out, drives the market through the old low, and you have a breakout trade set up to short the market. Equally, if some good news comes out during an uptrend, the major market event has a positive result for the market, and the trend is up, then that you can use your breakout trade and trade with the momentum of the market. So, in essence, this is probably the best way of both combining an appreciation for what's happening in the news with a general perception of price trends and technical analysis. It was a blend of fundamentals and technicals. The fundamentals are almost providing you, again, a sort of timing for your technical strategy and understanding of how the market is moving. So I was going to suggest having a look at the LCG Trader platform. Well, what I would probably say at this point is, because we're near the halfway mark, the half an hour mark anyway, I can always go through some examples if anyone had any particular markets they wanted me to just look at for now. But we're not far away from Monday when I gave my general market consensus anyway. So I'm going to end the official recording here. And again, if anyone has any questions, I can certainly cover that afterwards. But I think we've probably covered the bulk of what we need to here. So I hope that was useful for everyone. Thank you very much for attending today. And again, if you did find it useful, certainly subscribe to us on the YouTube channel. Follow us on social media to get these videos as and when. And if you are watching this live, you can obviously rewatch it on one of those formats. So thank you again for attending, everyone. Much appreciated. Good luck with trading for the rest of the week. It's Jasper signing out.